Hey there. Do you ever wonder if you're planning for taxes properly so that you can grow your wealth more efficiently now and also have very efficient distributions in the future? In this video, we're going to talk more about pre and post tax type vehicles. My name's Steve Larsen with Produce Freedom, and I help people live the life they love by helping them create abundance and peace and financial peace in their life so that they can give back to others and those that they love. Today, we're going to review a little bit more about taxes. So, when you think about taxes, post tax, okay, do we put our money into a 401k, which is a pre-tax, or one of those vehicles like an IRA, an SEP, or SEP, or any of these type of vehicles that save tax now, but we have to pay the tax later? Or do we put money into vehicles that we pay with after-tax dollars now and don't get taxed in the future? So it's kind of, if you're a farmer, do you want to pay taxes on the seed or the crop? The seed or the harvest. Okay, you're trying to figure out what you do with that. So we're going to go into some of those topics. So just for an example, so we can kind of see this. These are the marginal tax rates for 2020. This is from the IRS website. And so as your income goes up, we all know this, that the percentage of you pay in tax goes up, right? So it's all tiered through here. And then as you go to the highest rank, so this is the highest one, 37%, married couples filing jointly, 622,000 of income would dictate that, or single taxpayers greater than 518,000. So the question is, if you're earning this type of money, or even any of these other tiers, right? Do we want to save tax now, or do we want to save tax later, right? We don't know, because we don't know what the government is going to do. They have this trump card in their, and no pun intended, this card in their sleeve, an ace in their sleeve, and they can change it and move it whenever they want. They need more money, they change taxes, right? And so knowing where our state is, we talked about this in the last video. This is David Walker and his concern about where taxes are going to go. We have to kind of take that into consideration when we're working on our financial plan. And again, this year, 22% of all US dollars ever created have been created in 2020. So that creates a lot of other threats to our wealth building, in addition to what we're talking about today. But we're focusing today on that. How are they going to pay for all this? Taxes, where do you think taxes are going to go? So you have to build those assumptions into your plan. So I'm going to bring up an example here, and this is a simple example. I'm going to exit out of this, and I'm going to bring this over. Okay, so this is a simple spreadsheet that I created for you, and let me walk you through this. So let's say you've already accumulated all your wealth. So whatever you did to get to this point, you're at the age 65 and you're focused on the next years, because I always love to begin with the end in mind. We want to figure out the result, right? We want to retire safely. So let's say that you saved $3 million in a 401k or something the likes, an IRA or a SEP plan or whatever. Well, post-tax, that would be about 1.9 million, right? So I'm assuming a 34% tax bracket on average over here. So what does this look like going out? What threat do we have to deal with? So let's say that you're a good boy or good girl, and you're following the rules of the 4% rule. And obviously, if you've seen any of my other videos, we blow this out of the water and I show you how to do this. But let's say that you're following conventional wisdom, Wall Street wisdom, which I disagree with. And you're taking the 4% withdrawal. Okay, so in this situation, you're just taking the 4%. In this situation, you're taking 4% less tax. So you're subject to these taxes. So this is saying, okay, if you are a tax rate at 33% for these years, 35% for these years, you see it's dipping into your cash flow a little bit. Let's say, someone else gets elected in these 4 years and they jack the tax rates up, and that cuts more into your thing. So because we don't control this, we don't know where it's going to go. So if we put money into pre-tax now, but taxes go higher in retirement, then that was unfortunate that we did that. If taxes went lower, then vice versa. So in this situation, you actually end up with less money doing it the pre-tax way. Now, what happens if for a few years someone goes rogue and they even jack this up to 55%? Right? You just see your wealth getting swept away. And vice versa, if it went down to 32%, then you see some of your money come back. So here's my point. When you're doing this type of planning, we have to create some type of assumptions. But my point is you can't win unless you diversify. We've all talked about diversifying in the market, getting assets in different type of asset pools, making sure that sometimes they have an inverse effect. But we don't talk much about diversifying our tax portfolio. And so how do you do that? If you can only use a Roth, right? That's the only thing that's available. You can only put right now $6,000 a year per person. And you may not even qualify that if you earn too much. Are there other ways? Yes, there's other ways. So I'm going to end this video now. In our next video, I'm going to talk about how there's even more tax risk at play in your wealth that you may not even think about. And we're going to talk about how income tax and the estate tax are really hitting you, and you're paying way more in tax in the government than you ever would imagine. So I'm going to end this video here, and then we'll jump to the next one.